Bitcoiners have long talked about the largest oil producers in the world getting onto the Bitcoin standard. One of the key elements to that story was that those oil producers would end up realizing that Bitcoin was the most profitable use for their energy production. Now that is exactly what we're finding out. Yesterday, ExxonMobil, it became official that they have been mining Bitcoin. What they are doing is they are diverting excess natural gas that usually would go to flaring and being burnt off into the environment. They instead are sending that over out of their North Dakota facility to their partner, Crusoe Energy, where they are mining Bitcoin. The largest US oil producer is now mining Bitcoin. That is a big, big deal. They are not the only oil producer in the United States who's doing this. We found out a few months ago that ConocoPhillips was doing the same. Now, Bitcoin mining is preventing environmental damage. This is counter to the public narrative. Now that we know that ExxonMobil is diverting that excess natural gas that would have been flared to mine Bitcoin, you have to support Bitcoin mining if you're into climate change and actually making sure that the environment is taken care of. What we are watching is a complete narrative violation. Bitcoin mining is good for the environment. It prevents all of those bad things that come from gas flaring from occurring. And so we've got this quote right here from the Exxon spokeswoman. We continuously evaluate emerging technologies aimed at reducing flaring volumes across our operations. It's exactly what you would expect from ExxonMobil, trying to do the right thing, trying not to flare more and more gas into the environment. They simply want to mitigate it. And if they can make money along the way, that's real interesting to them. Oil producers in the United States and internationally are coming to the realization exactly what Bitcoiners thought that they would. Bitcoin is the single most profitable use of their energy production. And now that the oil and gas industry is going all in on Bitcoin, I tend to think that there's no putting this genie back in the bottle. Ladies and gentlemen, every once in a while, I see something so stupid that I just have to call it out. Goldman Sachs recently put out a report. They included a chart that shows Bitcoin and Ethereum users. What they're trying to show in this chart is that the Ethereum users supposedly are way more interested, way more popular than the Bitcoin usage. Well, if we zoom in on the chart and start to pay attention, this is just bad math, ladies and gentlemen. The blue line is Bitcoin addresses with greater or equal to 0.01 Bitcoin. And then the Ethereum, that's that black line, is balances with 0.01 or more Ethereum in the wallet address. Sounds fine, right? Well, the difference is that that's $400 worth of Bitcoin versus about $30 of Ethereum. So naturally, they're comparing apples to oranges. This chart means nothing. It's literally just the manipulation of data. It's trying to twist a narrative that not only is wrong, but also it leads people to bad conclusions. As I always say, you have to have good data to have good analysis. This is bad data. These two things aren't correlated at all. And ultimately, Goldman Sachs, it's not their expertise. I don't think that they're being nefarious. I just think that they made a mistake. But you got to be careful. You have to always do your own research. You have to think for yourself and make sure that when you see a chart that looks this absurd, read the fine print. Bitcoin at $400 versus Ethereum at $30. What do those two things have to do with each other? Nothing. And so stay safe out there, my friends. Data can say anything. Today's an exciting day. Bitcoin hitting 45,000. I saw you tweeting up a storm, all kinds of different thoughts. How are you feeling about sentiment on Twitter and kind of in the market in general?
I'm good. It's pretty mixed. I feel like some people are still kind of in disbelief, but you do have a few people in the timeline who are kind of euphoric. So seems like a good kind of mix here. I mean, general vibe does kind of feel like disbelief, though.
Hey, what bears have to remember is that you can be bearish at certain points and you may make a little bit of money, but ultimately you're picking up pennies in front of the steamroller. This is a decades-long trend, and we only going up. And so
bears win the battle, bulls win the war. So
facts. Will, you should be on a plaque somewhere for saying that. That's a great, great thing. All right, talk to us about some of these charts you got. First is you've got the this price chart. You got a whole bunch of different levels, green and red, that are outlined here. What is this showing us?
Yeah, as you just said, these are basically just price levels I drew out. I think the kind of main point I wanted to just get across here was just saying that I think at this point, we're kind of right below major resistance. And so from like a short-term kind of trading perspective, I don't think the RR here being, like giga long is great until we clear that resistance. You never want to buy right below resistance. You never want to sell, right before we hit major support. And so just from that perspective, as we're kind of pressing up against that major resistance, if I was a short-term trader and I wasn't already long, I would kind of just, wait out to see what the reaction here is at this level. But nonetheless, again, we're approaching this, major resistance level, both kind of in this consolidation pattern that we've been in, as well as just, horizontal price structure going back over the last year or so, which is right around 46, 47K. That's also around the yearly open. There's a few different moving averages over there as well. But that's kind of as I feel like we've been talking about for several weeks or whatever, that's kind of a key level that I've been watching. And then another kind of, I have two other ways you can look at confluence with this in addition to everything I just said. The first one is the next chart, which is short-term holder cost basis. So we talked about this last week, so I don't want to repeat myself too much. But essentially, this is the aggregated cost basis of all market participants that have been in the market for less than 155 days or less than 5 months. And right now, this kind of aggregated cost basis sits at 46,200. It does kind of move around a bit, week to week whenever we speak, but generally it's been hanging out around 46 to 47K. As of today, it's sitting at 46,200. And then last kind of thing that I wanted to point out on the confluence of 46 to 47K being kind of an important level is the third chart. The third chart is looking at basically a heat map of all the bids and asks across different venues. In particular, in this chart, we're looking at Bitfinex. The reason we're looking at Bitfinex has a higher hit rate than most of the other venues. If not, they have the highest hit rate. Kind of back testing, looking at all of the kind of, quote unquote, walls that they set on the both bid and ask side. Generally speaking, Bitfinex tends to kind of be the smart money in a sense. And whenever they kind of, place either a buy or sell wall, that tends to have some dictation on future price movement. And so what we see currently is that they had just actually in the last hour or so kind of set this ask wall between 45 and 48K. So that's confluence as well. You're seeing some large asks step in from Bitfinex in particular. What you don't want to see is like a partial fill. So this seems kind of counterintuitive. Like what you want to see for bulls in this scenario, because we're talking about an ask wall, you want to actually see it fully get filled, see all their orders get filled. And conversely, if it was a bid wall, what bears would want to see is, full fill of the bid wall. The reason is because the market basically moves in two ways. It moves because of, effort and absorption. So effort being active orders that are stepping in, right? So when you just go on, whatever venue you're using to allocate to Bitcoin, you just market buy, right? You're buying at the market price. It's like if you go on eBay, right? And you hit buy it now, right? You're willing to maybe pay a little bit higher of a premium just to go ahead and get the exposure and lock in your purchase, right? And then there's limit orders, and limit orders are essentially saying, and I like to use this eBay analogy because I think it makes somewhat of sense. You go on eBay, something's listed for $50. You don't want to pay $50. You say, well, I don't deem that fair value for this item, but I'll step in and place a bid at, $40. If it fills, great. That's where I think this is, worth my, purchasing power. If not, then that's cool. It didn't reach what I think is fair value. It's the same thing in the order book for Bitcoin, right? And so people come in and they set limit orders, both on the bid and ask side. And so whenever you see, a clump of bids or asks or wall, whenever you see that fully fill, that means that the effort in the market is outweighing the absorption. So in this case, if we see this ask wall get fully filled, to me, what that's indicating is that the effort or the active orders is outpacing the amount of absorption or this wall of asks that we're looking at now, or limit orders that we're looking at now. So that's what I would be looking at. Kind of the bearish scenario would be these bids fill like 60, 70%, and then price reverses, because at that point it's showing you that the amount of effort in the market couldn't outpace the amount of absorption that was set out, if that makes sense. But yeah, aside from everything I just said, specifically talking about the order books. Across the board, looking at order books, on-chain, and technical analysis, all three are showing that the kind of 46, 47K area is an important level for BTC. And so when you talk about kind of, this other framework that we've been talking about is kind of there's value buyers and momentum buyers, right? And so I think for a lot of those kind of momentum market participants or trend following strategies, a lot of those will kind of trigger if we can get above that area.
The global game theory around Bitcoin has been something that has been discussed for years now. And yesterday we hit a milestone moment. Russia is officially considering accepting Bitcoin for their oil and natural gas. Of course, Russia is under intense sanctions right now from the United States and NATO allies. And so naturally, they're turning looking for alternative payment options. What they specifically said in this quote is that they are going to go to those friendly countries like China or Turkey. We have been proposing to China for a long time to switch the settlement to national currencies for rubles and yuan. With Turkey, it will be lira and rubles. But then here's the big part. He said you can also trade Bitcoins. That's right. Russia is figuring out that maybe they don't need to use US dollars. It's a problem for the United States. But it's not just using the Chinese currency or the Turkish currency. Instead, they're also saying the apolitical money of Bitcoin could be an option. Now, if we go ahead and we look at this tweet from Nick Carter, he absolutely hammers the point home. Odd how muted the reaction is among the dollar global reserve forever crowd. Russia is the literal #1 natural gas exporter worldwide. If Russia starts to accept Bitcoin for oil and natural gas, that's going to change that global game theory. And then if you look at this tweet that I put out, I said every country is going to accept Bitcoin for two reasons. They can have confidence that no other country will debase it, nor can any other country seize it. The global game theory is real. And that's exactly what we're watching play out here. Russia considering accepting Bitcoin for oil and natural gas is a major moment in the development, not only of Bitcoin, but also in the de-globalization that is underway. Russia is not playing around. The United States and NATO allies put them in this position. And now we're going to have to figure out, how do we respond?